Gold is approaching a major liquidity zone, and smart money is actively preparing the next macro move. My primary focus for today's explainer is a precise long setup, but there's one strict condition that absolutely must happen first. Most retail traders are looking at completely the wrong level right now. Let me show you where institutions are actually targeting.
My daily directional bias remains firmly bullish. The primary target we're seeking is the external buy-side liquidity resting right at the 4442.40 all-time high. The objective is crystal clear, and the opportunity is significant, but the entry is going to require absolute patience.
But here's the problem. Before price can expand to that target, it needs fuel. So where is smart money actually hiding their orders to engineer this expansion?
To understand the next move, we've got to anchor our macro narrative. Just look at the daily time frame. Following that violent macro expansion out of the 3980 liquidity pool, price surged to test liquidity above the 4435 region. Smart money has already engineered the major sell-side run, and institutional order flow remains heavily bullish.
Now, let's zoom into the internal structure. On the H4 chart, you can see price swept relative equal highs near 4440 and is currently in an internal retracement. Drop down to the H1 and the true objective reveals itself. Price is pulling back to balance out inefficiency, seeking deep discount arrays before resuming that macro trend.
Let's map these arrays precisely. The current H4 dealing range runs from the 4312 low up to the 4440 high. That puts equilibrium exactly at 4376. Anything above this level is premium, and we simply do not buy in a premium. Price must deliver below 4376 into the discount array. Specifically, we're watching the confluence of the H4 and H1 bullish fair value gaps right between 4350 and 4382. This is your high probability institutional buy zone.
So, what's going to act as the engine to drive us down into that zone?
Institutions don't just move price randomly. They require a catalyst. Right now, objective macro drivers are aligning perfectly. Geopolitical tensions are driving safe haven flows into the dollar index, while US 30-year bond yields have spiked to 5.315%, a level we haven't seen since 2007. In this environment of uncertainty, institutional focus aggressively shifts toward calculated liquidity sweeps.
And they'll use today's high-impact news to execute exactly that. In late Asia, expect some consolidation and initial manipulation. Then, at 1 p.m. during the London kill zone, the GBP claim and count change will inject some serious volume. If that doesn't trigger the sweep, the 7:30 p.m. New York kill zone featuring USD building permits will act as the volatility catalyst to run sell-side liquidity directly into our H1 fair value gap.
Now let's translate this into an executable M15 model.
We know the why and the where, so let's detail the exact parameters for this setup. The entry zone is strictly between 4375 and 4382. Your stop loss goes at 4364, tucked safely below the institutional structure. Take profit 1 is at the M15 bearish fair value gap around 4405. Take profit 2 is the H1 swing high at 4425, and our final objective is that external buy-side liquidity up at 4442. This gives us a highly favorable risk-to-reward ratio of 1 to 4.5.
But look closely at the M15 chart right now. Despite having a highly asymmetric plan, there is absolutely no trade at this moment. We must wait for confirmation. The smart money footprint hasn't appeared on this time frame yet.
We don't guess, we react. Here's the exact mechanical 4-step institutional confirmation trigger you need before risking a single cent of capital. Step 1, allow price to deliver lower into the 4372 to 4382 discount zone. 2, wait for a clear M15 sweep of the 4380 sell-side liquidity. 3, demand a sharp M15 bullish displacement that creates a market structure shift. And 4, enter strictly on the retracement into the newly created M15 fair value gap.
This brings us to the most dangerous part of today's explainer, the retail liquidity trap.
Let's discuss the exact level where most retail traders are about to get trapped and liquidated. Compare the retail trap against the institutional target. Retail traders are eagerly buying what they perceive as higher lows at 4390, placing their stop losses directly underneath. Smart money is doing the exact opposite. They're waiting for the 4390 breakdown to sweep that exact pool of retail sell-side liquidity resting down at 4380.
The market is sending a very clear warning signal here. As the institutional data suggests, early buyers are simply engineering the liquidity for the Judas swing, a false directional move. This false move is designed to trap premature longs, utilizing their stop losses to fill institutional buy orders right before the true expansion begins.
So how do we maintain our institutional edge?
We strictly define our parameters and our absolute line in the sand.
Our bias is solidly bullish, targeting 4442.40. The sole trigger for entry is an M15 liquidity sweep at 4380, followed by bullish displacement. Our hard invalidation is an H4 body close below 4350. If that happens, the bullish narrative is immediately canceled. Post-confirmation, this setup carries an 85% confidence score. Remember to maintain strict risk protocols, maximum 0.5 to 1% risk per setup.
Trade this setup with institutional precision. If you enjoy this explainer format and institutional-style market analysis using ICT and smart money concepts, be sure to subscribe to ICT Market Theory. And if you want to trade alongside these setups, you can find the FXTM account link in the pinned comment below.
The board is set and the liquidity pools are primed. The only question left for today is this: will you exercise the patience to wait for the trap to trigger, or will you become the liquidity?